Manishi Raychaudhuri, who is veteran investor, of course, in Asian equities, but also the founder of Emma Capital Partners. Manishi, always great chatting with you. So it's a good day to start, and 2026, I hope it's a very meaningfully good year for you. Let me convey those best wishes to start off with. First off,
Well,
Manishi, it's a
thank you
fast
very much.
evolving. Thank you so much. It's a fast evolving world, right? There's just so much happening in geopolitics, and little would one have expected at the start of January 2025 that the world would change so much. How should one place bets this year, given all of the learnings and all of the uncertainty that's built up over the last 12 months?
Thank you very much, Hirsch, and a very good morning and happy New Year to you and to our viewers.
Thank you.
Well, 2026 has started with a bang. So Asian equities, MSCI Asia ex Japan is up more than 4% in just a few days, like 4 or 5 working days. There are 3 or 4 main themes that we are focusing on in Asia. The first of these is this big fiscal stimuli that started in 2025 but are likely to continue in the developed markets. So we have President Trump's One Big Beautiful Bill Act, the OBBA, as we call it. That's going to pump in more cash in the hands of householders in the United States. We're seeing similar fiscal expansion in Europe, particularly in Germany, which would take its infrastructure and defense expenditure to, in course of time, over time, it'll take it to about 5% of GDP. These are really big numbers. We're likely to see more fiscal spending in parts of Asia also, so particularly in China, which has been close to deflation for quite a few years now. The second important theme, and that's prevalent all across the world, is continuing geopolitical tensions. I don't really have to elaborate more on this. We have all seen what has happened. And I would think that kind of related to the first and second bit is a significant uptick in base metals prices. We've seen precious metals do really well in 2025. Over the last quarter, even base metals, aluminum, copper, they've started doing well. We are possibly kind of in front of a super cycle in base metals because the kind of demand that we're likely to see as a consequence of AI spending is unlikely to be met by the kind of capacity additions that are coming on. So if I look at all these, and I just hinted at that AI capex, we think that that's likely to be an ongoing theme across, across the world, mostly from the hyperscalers, but even new companies are joining in now. And as a consequence, the AI picks and shovels companies are also likely to do well. And many of them are in North Asia, in Korea, Taiwan, and China. So, to cut a long story short, we are positive on Asian equities. We have a target which is close to about, I think the market has moved up, of course, so it is hardly about 5 to 6% higher than the current levels. But this is kind of an ongoing target. And if we see the earnings estimates move up, which we're already seeing in Asia, unfortunately not so much in India, then we would be having to sort of even upgrade those targets that we have.
Okay, Manishi, thanks for that explanation. Hi, morning, and wishing you and your team a very happy new year.
Thank
Talk
you.
to us about where within the Asian market in 2026 are you expecting to see outperformance, and where does India appear, or how is India ranked on your list?
Right. So as far as India is concerned, I have a Sensex target of 91,000 by end of 2026. So from the current levels of 84 to 85,000, which is, I think, about maybe 8%, 7 to 8% higher. But we have an overweight on India purely because the stock selection opportunities are immense over there. And as a consequence of the underperformance of the market over the last 15 to 16 months, some of these stocks which have underperformed, they're possibly appearing even more attractive to institutional investors than they used to. So in our Asian model portfolio, we have an overweight on Hong Kong, China, and Korea and India. Though for India, it is more from a stock-specific consideration than a superlatively bullish outlook on the market.
Manishi, within the Indian universe, what are you liking?
Right. So there are 3 or 4 silos that we have there. We like the financial space. Apart from the second half of 2025, this sector actually underperformed over the last 3 years. We like the private banks over there. We like discretionary consumption, and we are playing that through automobiles, particularly the market leaders in the niche segments, and also some of the healthcare service providers, not so much the pharmaceutical companies, but more the hospital and diagnostic chains. Third, we also like the commodities. We are playing that through the conglomerates, like we have Reliance Industries in our model portfolio. Um, One sector that is conspicuous by their absence is IT services. You know, even though the rupee has depreciated and that has added some kind of tactical tailwind to the sector, we think that this is an AI loser for the foreseeable time horizon. So that is really, the kind of stock or sector selection we have. I forgot to mention the industrials, and not only the infrastructure and capital goods creators. One should also very keenly look at the defense uh, plays over there. One should be a bit cautious about the valuations because these stocks have run up. But the longer term pathway for infrastructure, capital goods, and industrials in India is, I think, fairly certain.
Okay. And Manishi, last time we interacted, you did expect the earnings growth to pick up starting January. Are you still reflecting that thought for the quarter 3 earnings season, given that updates that we've received so far have been pretty decent? Do you believe that this quarter could show some significant earnings upside?
Hopefully, yes, but unfortunately, I haven't seen any concrete indications of that yet. We tend to look at the Asian market. I mean, think of there are about 10 markets and somewhere around 8 to 10 sectors in each of these markets. So there are anywhere about 180 to 200 market sectors in all of Asia. Out of these, there are about 38 sectors which are showing pretty robust earnings estimate increases. So over past 1 month, 3 months, and 6 months, their earnings consensus earnings estimates have increased. Now, unfortunately, there is not a single sector in India which shows that trend. We're seeing that in North Asia. We're seeing it in Chinese financials and basic materials, in Korean technology, Taiwanese technology. Um, and in the consumer discretionary space in many of these markets, it's few pockets in ASEAN as well. But not a single sector in India is actually showing that earnings upward inflection. And that's a bit worrying for me because, for a whole of Asia, that upward inflection has been catching on over the past 1 or 2 quarters. So I think we will have to wait for this quarter's earnings to come in. A lot of fiscal stimulus has been pumped in last year. Anecdotally, we have heard from automobile companies, from other consumer discretionaries about bumper sales during the festive season. Um, Hopefully, that catches on in terms of earnings upgrades.
Right. Uh, Manishi, you also have a very good view with regard to the globe, which you've obviously spelt out. But talk to us about what this does and talk to us about that in context of Indian IT. Do you believe that recovery could well surprise on the upside? Because currently it's the anti-consensus trade, if I can call it that. It's the big contrarian trade playing out in Indian markets. Can IT surprise?
Great. So, as far as Indian IT is concerned, there are pulls and pressures from both sides. As AI capex catches on, as it accelerates, there are more than, about 100 to $150 billion per quarter being spent on the AI data centers. At some point, integrating these data centers would, obviously need the traditional IT service which the Indian companies provide. But at the same time, as a consequence of the LLMs coming on and increasing adoption of these LLMs, not just in terms of creating text and videos, but also in terms of writing code, there's a significant degree of the service offering of the Indian IT companies which is threatened by the more sophisticated LLMs that are coming on. And many of these LLMs, particularly the ones from China, like DeepSeek, they're virtually free to use. They're negligible at negligible cost. Developers can access those LLMs and connect them to what they call the APIs. So, it is. I think for the time being, it'll be difficult going for Indian IT companies. At some point of time, I understand that they're also investing in AI capabilities, and they would obviously improve productivity. But for now, on the AI theme, I would rather play the adopters who are able to increase their revenues adopting the LLMs, and also the picks and shovels companies, the memory companies, or the Chinese and Taiwanese chip manufacturers and the fabricators.
Okay, and Manishi, lastly, before we let you go, just wanted to get your thoughts on what happens to China and India and their economies going ahead now that Trump is issuing fresh sanctions on countries that are trading on the oil front with Russia. Do you think that could meaningfully hamper the growth outlook for economies like China and India? And does that change your view on how these equity markets could do?
Well, China is having its own problems as far as economic growth is concerned, and the biggest problems over there are basically a household consumption, domestic consumption, which in turn is influenced by the property market, which has been in a downturn over the past 5 years. And there is still no significant sign of consumption sentiment or the property market improving. China is focusing on other areas, which they called new productive forces, which some of them we know about, the new energy, electric vehicles, where they have not only huge manufacturing capacities, but also intellectual property, which is way better, way higher than even the developed markets. But these new areas, new parts of the economy are relatively smaller compared to infrastructure and the property construction, which is a significantly larger part of the Chinese economy, and that's been in doldrums for quite some time. Um, I think for China, the bigger problem is what's happening domestically. I mean, this most recent geopolitical issue with US and Venezuela has curtailed some kind of, some portion of the crude oil that they use to import, but that's really small. It's about 4% of China's total crude oil import. I don't think it's going to, impact China's energy security in any meaningful fashion. In case of India, the problem is the other way. I mean, India needs to invest a lot more in infrastructure, and even private capex needs to come in. The government has pivoted from industrial investment, from infrastructure to consumption to a certain degree in 2025. But we're yet to see the impact on private consumption, particularly urban consumption coming in. So, I mean, these two countries, in a sense, face different problems. In case of India, I would also like to see in the budget how they plan to reduce the fiscal gap. Are there any plans to monetize government assets? So these are some of the most important things to watch out for as far as these two markets are concerned.
Okay, Manishi, really appreciate your time this morning. Thanks for joining us and speaking with us.
Thank you very much.
Thank you.